And now let's work on the learning objective number 4. This is to explain the different types of accounting changes and account for the correction of a prior period error. Different types of accounting changes and account for the correction of a prior period error. So first is the changes in the accounting estimation. So remember, we talked about one example would be the calculation on the depreciation expenses, right? If you recall, we have 3 common methods: straight line method, diminishing balance method, and the units of production method. So if you still remember, we have to make some estimation before we are able to do any calculation. So we need to estimate what is the residual value would be, how much you can get out of it at the end of the useful life. And we have to estimate the number of the years of useful life. Okay, how long can we use this asset? Okay, this is all accounting estimate, right? And based on these estimations, we are able to perform the calculation, right? Now, the issue is we are living in a dynamic, fast-changing world, right? A lot of the world, even now today, is full of uncertainty, right? We just experienced the 3 years COVID period of time, and that has changed many aspects of our life, the way how we work, how we study, right? So people are more acceptable to working remotely at home. They like this very much. And it's really hard for the employer today not providing employees with a flexible working plan, right? They will be very hard to find the employees. So it's interesting, right, how the world is changing so fast. And you just have new information all the time. Did you guys follow on the AI Sora? The artificial intelligence Sora is a way to generate movies. So AI is able to help you to generate videos. Yeah, it's really impressive, like how you can simply enter descriptive information in using words, using text, and then the model is able to just rely on the information you provided, the description, to not only provide you with a picture, but they provide you with a movie, right? It was so crazy how things is changing nowadays. How that's gonna change how people work, right? So you used to rely on the best information you have to have an estimate, but things has changed very rapidly, right? Now you have a new set of information. You learned that my residual value should not be 10,000. It should be worth nothing. The number of useful life should not be 20 years. It should be 30 years based on the information I have now, right? So in that case, you have to change these accounting estimates. Okay, you have to change it. But the question is, right? I already did previous year's calculation on the straight line amortization. I already calculated the depreciation expenses in the previous years. And now you are telling me that I have to change my accounting estimate. What should I do with the work that has been done previously years ago, right? So the idea is if you are changing accounting estimate, okay, you do not go back to the previous years to change the previous year's number. So this one is only prospective. You only start using the new estimate going forward. Okay, so going forward, you're going to rely on the new estimate information to do your calculation. But you don't need to go back to the previous years to recalculate depreciation expenses based on the new estimate. Why? Because back then, your estimate, there's nothing wrong with it. It's based on the best knowledge, best information available at that time, right? And now the information, the situation has changed. You have to change the estimate. That's fine, but that's that is only going to affect the future, not the past. Okay. So we call this prospective, not retrospective, retro prospective. Does this make sense?
Yes.
Hey,
Yeah.
awesome. Now, changing in accounting policy. This is different from changing in estimate. When I say change in estimate, we are saying, well, we estimated the residual value is 10,000, and now my new estimation is $0. I estimate the number of useful life was my old estimate of the number of years of useful life is 20 years, but now in my new estimation it's 30 years. So you can see that's called the change in estimate. What is the changes in accounting policy, right? Accounting policy is that, well, we use straight line method to calculate depreciation expenses. So that's the accounting policy. How do you calculate the depreciation expenses? Well, we use a straight line. Now, I want to change it. I want to change it to be units of production, not a straight line method. This is called change in policy. It's not about estimation. It's really about you are using a method before, right? But now you use a different method. This is called changes in accounting policy. When you change accounting policy, you have to go back to the very beginning to change all the numbers. Okay, let's say 2 years ago is the first year you start record the depreciation expenses. Guess what? You have to go back to the beginning of the 2 years and then recalculate that year's depreciation using the new accounting policy. Okay, so you can see the previous years also need to be dealt with, which we say this is retrospective application. Okay, does this make sense?
Yeah.
Okay. The third one is error. We are human beings. Sometimes we made mistakes and we are not able to catch it right away. Let's say last year, there is a dollar amount of 68,000, but you mistakenly write it down as 86,000. And you didn't find it until the next year, right? Then you have to perform a correction. How does that affect your income? Is that understated or overstated last year? Okay, and then you are going to make the correction to the return earnings. Okay, to the return earnings. Why to the return earnings? Because all the income expenses are closed to the all the income and the dividend are closed to return earnings, right? So if there's any issue with the previous years, okay, and we know that that issue has impact on return earning, so therefore we're going to fix the return earning. Does this make sense?
Yeah.
Okay. This one, you have to go back to the year when the error was made, right? The previous years, and fix those errors. Okay. In this example, the interest expenses were overstated. So the effect is the profit is understated. And the income tax payable is understated. Okay. So if your interest expenses is $10,000 overstated, your income will be $10,000, okay, understated. So therefore, you should recognize additional liability and additional earnings, right? Additional earnings. So correction will be added to the opening balance of the return earnings. Okay, so that's what we did when we are dealing with this problem. Does anyone have any question?
No questions so far.
No, I don't.
Okay.